is fundamentally a supply side shock, and it's not a demand destruction story. So the rate hikes are not really going to create more oil in the system or more LNG supply. So and tightening the rates is too aggressively also is not going to suppress the imported inflation. It would be an unnecessary move that can hurt your growth for the economy. In the interim, I would expect the RBI to focus more on the liquidity management and focus on financial stability. So tools like your OMO, your VRR and VRRR and other liquidity support measures is likely to prevent the bond market volatility and keep the upper bound capped for some time for the yields, and they may not be as volatile. Now, that said, inflation is still likely to remain very elevated and sticky now due to fuel and logistics and your fertilizer ka pass through effect. In our base case estimate also, I have said that the inflation is likely to stay elevated up to the 4.8% for the year. But it is still below the 6% threshold that the RBI has, which gives the RBI some room to remain very patient and nimble without becoming very overly uncomfortable and react before time. So I think they will be on a wait and watch mode. But the demand, however, is gradually picking up. And if crude sustains around elevated levels for longer, see some shift in conversation Q3. So in the near term, of course, focus is going to be on liquidity and they would like to maintain a pause. In the medium term, maybe gradually, if things normalize and if inflation is still sticky and persistent, then it may start feeding into your broader demand side pressures as well.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.